Hello, I'm Roman Keeney. In this session, I will be giving you an overview of the GTAP framework. Our material today is introductory, so we're going to begin with an exercise where we think about what a CGE, or a computable general equilibrium economy, looks like in the single region. So we'll do this exercise of a closed economy, and we'll use that to expand to the multi-region model that we need for trade and international finance. We have a couple other things on our agenda. We're going to look at the notation that's used in GTAP, review that, and try to understand the logic behind it. And then finally, we'll point out where the advanced topics arise in this overview. When we do an overview, we are going to be passing over things like demand and savings. We're not going to take the time to break all those out in this lecture because those are specialized topics of their own, and you'll find that we have other material that goes deeper on those. So we are going to begin with this exercise, and this actually has a strong legacy in GTAP education. It's actually called the 1GTAP model, and if you hunt around online, you could probably find it, and some teaching materials that go with it. It's a closed economy, single region, and it's used to train people and get them used to the idea, especially partial equilibrium modelers, get them used to the idea of a circular economy. The idea that we have a household in the region that is going to be demanding goods, but is also going to be selling its labor and its capital to the productive sector that it's buying things from. And so when you start to think about prices, the price of labor is connected to the same things that the demand that you express for purchases. And then, of course, those demands are linked back to income, so the sale of factors of production. And so you're operating on an income constraint. And so these price linkages, this price system of a closed economy is really what we want to talk our way through. But if we look from the top down, you see that there are all sorts of behavioral assumptions that we would use economic theory or empirical economics to try to understand, not the least of which is the demand system that arises from a regional household maximizing utility, or the producers. They're going to be cost minimizing producers down at the bottom of this graphic that we're looking at. They have demands for inputs, not just the primary factors, but from each other. So one producing sector may demand its own output as an intermediate input. So that's the intersectoral linkages that are always critical to any input-output system, but are a big driver of the production side of a CGE model. If this graph is sort of a new type of look for you into circular economy, just remember that the key to following everything is the payments follow the arrows. So the arrow going from the regional household down to government is titled government expenditure, and that means the regional household is allocating some funds to purchases that we would call the government or public consumption. So we are going to break this down just a little bit and think about the demand at the top level, because this regional household is a very important feature of CGE modeling. How are you going to treat the purchase side? And the treatment here is unique to GTAP. We have developed this regional household which solves a utility problem for the region and says we need an allocation of all the income into three expenditure categories: private expenditure, government expenditure, and something like future expenditure, right? So not this period. And we just call that savings. And so that's the money that's set aside. It'll be placed into an investment account or an investment good. And so you have this top level allocation, again, determined by the ultimate demands. And so we'll follow this tree, this track down to understand what we have. The regional household, as a top level entity in this model, it's going to receive all the income, it's going to spend all the income. And of course, we should be able to justify why we treat the region this way, the demand in the region this way. And it's really to get this consistent welfare indicator. If all the expenditure comes from a single function at the top level, it means that we can write that utility problem. It means we can convert that utility problem to a base utility level that we could use to derive a welfare indicator. Anything that comes with an advantage almost always will have a disadvantage with it. And in this case, the fact that we're treating this expenditure problem at the top level means it's independent. The budget for the regional household is independent from the amount of government spending that occurs. It's going to be a share of total income and not specifically a government budget that's allocated. We follow our way down the circular economy. Now just looking at those three expenditure categories, the government or public goods spending, private expenditure, and savings, and we get our connections to the producing sector, the entity in this model that has a production function. So our goal in the notation in GTAP is to keep it consistent enough that the learned reader can intuit the meaning of anything they see, but it is important to remember that everything is documented in the code. So we do have documentation written out for GTAP, but tremendous effort has been put into adding all of the information one would need to uncover what everything means within the code through the comments that are introduced in the code or the labels that are attached to, for example, variables. But we do have this reminder here of the notation. So in general, we should be looking to the first letter of a coefficient. So something like VDPP that is introduced here as the private purchase expenditures. The first letter is telling us whether we're seeing a value, a quantity, or a price. The second letter should tell us whether we're in the domestic market or the import market. The third will give us the agent who has the behavioral function we're looking at. So private, government, investment, or firms. And then finally, what price we're looking at. So we've talked about circular economy. We've talked about the idea that you have sellers and buyers who are the same. Well, in any transaction, you can only be one or the other. Right? So you're the regional household. You sell endowments to the firms, but you buy goods from the firms. And so we'll always keep track of whose price perspective are we looking at. And that'll be important in the data because we're going to have policy interventions. And so if you have someone selling labor to the producing sector and there's a tax or subsidy on the use of labor by the producer, then their price will be different by the amount of the policy intervention that's there. Okay, so we've tracked our way from the regional household down to all the different payments that can be made for products. So remember, first we have an allocation to what type of spending the regional household has, the public or the private or the savings. And then if you track those arrows down to the firms, you'll see that they're actually purchasing goods from the production sector. The one exception is the savings. GTAP is a savings-driven model, so we make the allocation to savings, to thinking about, in a comparative static sense, how much money is set aside for future consumption. Those savings expenditures are placed directly into investment, and then there's an investment good flow. The producing sector experiences depreciation. They are going to have a demand for new investment, and so that was what controls that in this circular economy. That producing sector also pays for factors of production, and so we've highlighted in this slide just the coefficient, the data entity called EVOS, which is the value of endowments at the supplier's prices. So those are priced at the labor or the capital owner's selling price. Okay, so the earnings of the sale of labor or capital is obviously a primary source of income to the regional household. Earn that income, it sets the budget constraint for how this expenditure problem is going to be solved. How much is allocated to private consumption, how much to government, how much to savings. But there's another piece of regional income that has to be treated in the circular economy, and that's the taxes. And so while it may be normal to think about there being a government account that collects all the taxes, and then that government account does its spending against that budget constraint, sort of a fiscal model, GTAP bypasses that. So we've already said there's no direct linkage between government spending and government revenue as collected via taxes. And so what we see here is all the taxes. You follow these red arrows. Remember, the direction of the arrow is the direction that payments flow. And so everywhere we have a transaction, we have the potential for a tax to generate revenue and to send income to the regional household. And so at the bottom of the slide here, we see that we have the income equation, or the income identity for this model says that take the payments on endowments at the seller's price. So this is the labor owner or the capital owner's pricing, EVOS. Add to it the taxes that are collected on transactions in this economy. Take away any subsidies that are paid out, negative taxes. So the net taxation plus the sale of endowments will always be the income. So let's just summarize the single region exercise we've done. So we just looked at a closed loop or circular economy. It was autarkic. There was no trade. There were no interactions other than the demand side, or the household side, if you prefer, that owns factors of production and generates demand for goods, whether it's through the private side or the public side or through saving. Their only option is to go down to the firms that exist in the region. The regional household could be thought of as the owner of these firms, right? The firms really just exist as technology. The capital, the labor, the sort of productive factors are owned by the regional household, and they're rented to the firms, right? The firm is really just a technology piece in this model. It solves a cost minimization problem to determine the factor demands, but in some ways we're treating the region as its own sort of behavioral unit. And under this sort of autarky, you get a fairly simple set of balance equations. The income has to equal the expenditure, so you have to exhaust income into one of the three categories, either public spending, private spending, or savings. Supply equals demand. So everything made in this autarkic region or autarkic economy has to be sold, right? We need to balance that out. And then savings in the region has to equal investment. So we do this single region exercise to get a picture of what the sort of unit of economy is going to look like in a multi-region model. We are going to have many regions when we move on to multi-region modeling, but this core unit of a region is going to look the same. The one difference is we're going to link it out to other regions. So we're going to break the autarky assumption, deal with that. To summarize just a couple other things that would help us sort of set the behavioral assumptions of this. Two things that are fairly standard for CGE models. The first being perfect competition with constant returns to scale. So we have price-taking firms with linear homogeneous technology. That's fairly common in these sort of IO-based production models. And then comparative static means you allocate money to savings, it purchases an investment good, but it has no effect on current period productivity. Okay, so there's no capital accumulation. You would need second period models to start to get the effect of investment. So while those are standard for most CGE models, we would consider that sort of a common thread, GTAP is a little different. And we have some sort of standard assumptions. If you're looking at a GTAP flavor of a model, it probably includes private demands for goods and services using the CDE function. So there are lots of options for setting up the demands by households for goods purchases. And the standard GTAP approach is to use CDE, specific sort of flexible functional form. And obviously we have specific training that focuses on how GTAP does that. The regional household sets GTAP apart from some other models, treating all of the income collected in one place and doing the allocation to the three types of expenditure. And then finally, the focus in GTAP, or the sort of origins of GTAP, have always mandated a fairly disaggregated approach to primary agriculture. GTAP has its origins in an agricultural economics department, and a lot of the early work in GTAP focused on WTO and agriculture being brought in under the Uruguay round. And so with these agricultural splits, which makes land an important factor of production, and land is a primary factor that does not easily move between uses in agriculture. And so it can be very difficult to move paddy rice land to row crop production. And so GTAP has this sort of tradition of giving the modeler flexibility to introduce sluggish primary factors that move at some cost between uses. Having completed this circular economy exercise for autarky, let's think about what the GTAP standard model means when we go to multi-region. So GTAP, as it exists off the shelf, is ready to describe a global economy in the database and in the equation system. But really what it is a bunch of single region economies where we introduce linkages, bilateral linkages, region to region, that deal with the trade flows that exist in data that we can see empirically and the international financial flows. Each of those regions is going to look like a core unit. It's what we call functionally replicate. It means if you look in the code, what you see is an equation that describes some behavior for a region, and it just takes a region index. So what's going to be different region to region is the core data, right, the size of the economy, and any parameters that describe how they respond when prices begin to change. So we have these regions as structural units, and so our goal then is to use data that exists in the global economy, but has bilateral information to link the economies through trade and investment. In terms of our circular flow economy picture, we can handle this fairly easily. So we take the circular economy that we had that went from regional household down to producer, and we add one box down at the bottom, and we call it the rest of the world. And so for the purposes here, we think about the rest of the world being one other region. And if we drilled into the rest of the world would have its own sort of regional household, its own set of producers, its own allocation between private and public spending, its own income derivation. But from the perspective of this circular economy that we've been looking at, we just need a linkage between those two. So how are we going to think about the global economy and balancing conditions while recognizing and respecting the fact that some of the purchases made by the private household or by the regional household's private expenditure allocation aren't just from the firms in the domestic economy, but they will also be from firms that are outside of the domestic economy, so in the international market. And so to do that, we introduce this box at the bottom, and we call it the rest of the world, and we trace out the payment linkages. Again, the arrows point in the direction that payments go. And so you see from the private expenditure allocation, you now have the option to purchase domestically VDPP, or you can purchase the import version of a good, VMPP. And so those are the two different value flows made by private households to firms, one to firms in the domestic region, one to firms in the rest of the world. So just like the private household can buy goods and services from the rest of the world, so can the government side of the spending pattern, and firms can as well. So if you're the producer, the producing sector in the domestic economy, you can buy inputs from the domestic economy, but you can buy import varieties. And then to complete this trade picture on imports and exports, all we need then is to say that the producing sector of our region is allowed to export to the rest of the world. And so you see there VXSB at the bottom. Those are payments coming into the producing sector in our region because the rest of the world is purchasing goods. This multi-region model where we're linking up the domestic economy with the rest of the world, we've introduced some new transactions, the trade transactions. Those introduce the ability to set new policies. And in fact, any transaction can be taxable. And so we'll have some export taxes and import taxes. Those taxes being set by the domestic region, it's a policy choice they made. They will accrue the income for any of the exports or imports that move against those taxes. Those taxes just add to regional income the same as any domestic tax would. The final piece, we said we needed to link the economies through trade. Well, we need to link them through investment as well. And so here we have a small modification down the center line from the regional household. So instead of the regional household, they still have the allocation to savings as normal, but instead of their savings becoming investment for the firms of their region, it actually goes to an allocation mechanism. So there's a global bank that collects all the savings in our model from every region, and then it determines that investment pattern for that bank. And so capital will earn its return based on the sort of global average return and the differential between potential investments in different regions. Again, like some other things, this is a fairly complicated mechanism that we've introduced to make the model conform to the data we have on investment. And we'll have specific training available on the global bank mechanism. But for now, we just need to know that the treatment moving from single sort of autarkic region to multi-region is savings now goes into a global pool. The global pool determines the rate that you receive back on saving, and then it also determines an allocation. Where does investment go around the world? A single region and many potential regions representing the rest of the world. So we're focusing on our circular flow economy in a domestic region, but there could be many more. And in fact, the GTAP database tells us how many potential regions there are. As of version 10 of the database, there are approximately 140 regions. There are about 120 very specific I/O tables that are considered modern enough to represent a region. And so that's the sort of what we would call the core detailed coverage of GTAP at any time between 110 and 120, depending on how data ages and how useful it is. The rest of the world gets aggregated into regions where we don't have specific data, but we can put together a useful aggregate. GTAP has 65 production sectors. Now, at any time when you're running a model, you'll typically aggregate quite a bit of this information to get down to your regions of focus. So it may not be as narrow as the region I'm interested in, say Canada, and the rest of the world. It may not be a two-region model, but that's certainly open to us because GTAP is not just a code product, it's a database product. And it's a database product that allows you a lot of flexibility in designing the version or the way you want the data to appear in terms of regional and sector specificity. That's a big data base when GTAP is fully flexed out, and we have trade linking all those economies in that base data. So one of the other things you can do, if you don't want to only do GTAP models, you can get the full bilateral trade database looking at all those regions, track commodity source and destination, just like we would if we were looking at an equation in a GTAP solution or simulation. We will distinguish between domestic and imported goods, so there is some substitution that goes on. So we don't just have trade flows linking these, we have a behavioral assumption, and that assumption is going to be the Armington assumption. So suffice it to say, for the purposes of this overview, that it's just product differentiation by country of origin. We view the home good as different than the import good, and potentially we view the variety of a good that we purchase from Canada as different from perhaps Singapore. Okay, so there's this two levels, home versus non-home goods, and then where they come from are both sources of product differentiation. The advantage, of course, is that this is robust empirically. We see US and Canada trading in wheat, and wheat goes in both directions. So there are lots of models that would say one of these countries should specialize, whoever the low-cost producer is. But wheat is also an aggregation on its own of many types of varieties. And so without going into very detailed HS6 or lower levels of commodity specialization, we are left with the Armington assumption as a way of handling this sort of product differentiation just by saying the region it comes from is a proxy for that. Okay, we had very specific balance conditions in our exercise on a single region where we said demand has to equal supply, savings equals investment. Well, we have to expand that a little bit now, but it'll be a familiar equation to most economists. We have the current and capital accounts balance here, or we could, the balance of payments equation. Each region is going to have a condition that says the savings less investment must be equal to the exports minus the imports. So that's your traditional balance of payments equilibrium in open economy that has to hold. So if you're in deficit in one, you must have surplus on the other side. You get to finance these purchases somehow. So that's the regional balance equation specific to each region. And then if you step up from that, the balance on savings and on goods has to occur at the global level. So in a world condition or a global equilibrium condition, we'll have that global saving must be equal to global investment, and total exports have to equal total imports. So we'll get our goods balance and saving investment balance at a global condition. But any region can be in deficit or surplus. So this is we did this exercise on a single region. We went through and said, what are the sort of standard CGE features we've seen? What were the standard sort of features that GTAP has employed? Right, so what can we call sort of tradition of GTAP, tradition of CGE? And I've added three things here. Perfect competition and comparative static remain. And then the third sort of feature that is a thread through many CGE models is the bilateral trade through Armington. If we move to the other features, the things that GTAP has employed, we have the regional household, the private demands, but then we also have a couple of issues related to trade, and one of those is treating the transportation costs. So modeling those explicitly using a transportation sector that is global in nature. So every region has some transportation services. Some portion of those go into the global economy to move goods between regions. That means we need a balanced out transport sector so that any trade flow will draw upon that transport sector and have demand for those transportation services. The second of those is the investments linked through a global savings or global bank. So the investment, the savings for any region goes to investment, but actually what it goes to is a global savings pool with a bank looking at rates of return around the world and allocating that for the equilibrium condition. Again, two things here at the bottom that we consider sort of standard to GTAP, which means we also have training on those that are specific, digging through those topics. That's the end of our introductory session on the GTAP framework, where we've looked at an exercise of the single region and how we can take that single region core unit and think about it replicating into a multi-region model. Thank you for your attention.